Hello and welcome to this video on exchange rates and factors that influence them. So in this video we're going to look at what is meant by the term exchange rate and then look at a range of factors that influence the rate. So a quick reminder of what an exchange rate is. The best definition we have of an exchange rate is the price of one currency in terms of another. So for example, the price of €1 in terms of pounds or the price of $1 in terms of yen. This price is determined through the interactions of demand and supply on the foreign exchange market, often known as the forex market. Typically, why is foreign exchange bought and sold? Well, if I want to buy an import from abroad, or if I want to build a factory abroad, or maybe to try and make a profit out of trading currencies. So we're going to look in this video at 5 different factors that might influence the exchange rate, and we're going to look predominantly from a UK perspective. So let's start off with inflation. A reminder that inflation is a general rise in the average price level within an economy. So how might this influence the exchange rate? Well, if inflation in the UK is lower than elsewhere, then products in the UK are rising in price at a slower rate than other countries. So UK products, UK exports, become more competitive. Now, in order to buy something from the UK, you need to buy pounds. So there will be an increase in demand for pounds. Also, foreign goods will appear less competitive as their prices are rising faster. So UK citizens will supply less pounds to the foreign exchange market to convert for foreign currency because they're not buying foreign goods. Therefore, the rate of the pound will tend to increase. And so we can illustrate this in a diagram. Let's imagine we're comparing the UK with the USA. And we have the demand for pounds and we have the supply of pounds. And so we have the current value of the pound against the dollar. Now, if inflation in the UK is low, then Americans will want to buy UK exports because they seem quite price competitive. Now, the impact of that was that increases the demand for pounds. Americans want to buy pounds in order to buy UK exports. We will also see that UK citizens will be less likely to buy stuff from the USA, so they're less likely to sell their pounds and convert them into dollars, so we'll see a reduction in supply. The combined effect of this is that we would expect to see an appreciation of the exchange rate to P2. So the general relationship here between inflation and the exchange rate, if inflation in a country is higher than elsewhere, the price of its goods will be less internationally competitive. As a result, demand for exports will decrease, and in turn demand for its currency will decrease. This will cause the value of the currency to depreciate. So high inflation leads to depreciation. But of course the opposite is true, as we saw in our previous example. Low inflation would lead to appreciation. Now let's look at interest rates. If I was a very rich person with lots of money, I might spend some time looking to get the best return. So I might currently have money perhaps in a British bank account earning 0.7% rate of interest. But that return is not particularly good. So I might scour the world looking for a higher rate of interest, perhaps Mexico at 7.75%, or perhaps even just moving it to America at 2.25% to get a better return on my money. Now, how do I move money from the UK to Mexico? I need to exchange currency, and that exchange of currency would cause the value of the exchange rate to change. So let's have a look at some theory behind the relationship between interest rates and exchange rates. A reminder that an interest rate is the cost of borrowing or the reward for saving. If UK interest rates fall relative to other countries, it will become less attractive to deposit money in the UK and more attractive to deposit money in foreign accounts because I'll be earning a higher rate of interest, a higher rate of return there. In order to move my money from a UK account to an American account, I need to sell my pounds. I need to supply sterling. This theory is known as hot money flows, as money moves between countries chasing the highest rate of interest. And often doesn't stay for very long. It's moving based on the interest rate, so we call it like hot money flows, like a hot potato. and it's an important short-run determinant of the value of a currency. So again, I can illustrate the impact of this. Here we have my marketplace, the pound against the dollar, and let's imagine that UK interest rates are lower compared to in the US, or UK interest rates are reduced to below the level of the US. What would be the case? Well, first of all, I would see an increase in supply. People in the UK selling their pounds and buying dollars so they can move their money to America. I would also probably see less Americans wanting to supply their pounds to the UK. So I'd also see a fall in demand from pounds from Americans. What would I expect to be the impact? I would expect to see, as a result of the low interest rates, the value of the pound fall to P2. So the general relationship here is that if interest rates rise relative to other countries, the currency will appreciate, and obviously vice versa. If the interest rates fall, and this is the important bit, relative to other interest rates, then the currency will depreciate. Now let's move on and look at speculation. Let's stop for a second and think about an example. This could be you in a few years' time. You land the dream job as a currency trader in New York. On Monday morning, your first Monday morning, you sit down with a coffee and your boss has given you $1 million in your account to trade currency. The exchange rate is currently $1 to €1.50. Being a good currency trader, you read the market news, you read the economics news, and you believe that the Federal Reserve will cut interest rates on Wednesday. You might want to pause the video, and if you want to be a currency trader in the future, think, what do you do? Well, on Tuesday, you move your $1 million into a euro account, and your $1 million on Tuesday will convert at the exchange rate as it was on Monday, and so you will get 1.5 million euros for your $1 million. So now you have 1.5 million euros in a European bank account. On Wednesday, the Fed go through with their announcement and they cut interest rates. This causes the dollar to depreciate. $1 is now only worth €1.20. So what do you do now? Well, the smart cookies amongst you will note that on Thursday you should move your 1.5 million euros in the Euro bank account back into dollars. And at the new exchange rate of $1 to 1.2 euros, this would mean that you have $1.25 million in your account. Now if we compare that to what you started with on Monday morning, we'll see that you've made a very nice profit, $250,000 for 4 days work, so you can take Friday off. And we call this speculation, buying and selling currency in order to try and make a profit. So how does this have an impact on the exchange rate? If speculators believe a currency will fall in value in the future, they will sell more now to be able to make a profit. This increase in supply will cause the value to fall. So for example, if currency markets see news which makes an interest rate decrease more likely, the value of the pound will probably fall in anticipation. As people position themselves on the Tuesday by selling their dollars, for example, and moving it into euros, that selling of the dollar starts to cause the dollar to fall in value. So it kind of becomes self-fulfilling. So for example, again, if I look at my market and the UK central bank was to announce that it's going to cut interest rates, as soon as I suspected that, I would probably start to sell my pounds, causing a slight increase in supply, but causing the price to start to fall. If other people also suspect that the UK might cut interest rates, the central bank might cut interest rates, they're also going to start selling their pounds. And that causes supply to increase and the price to start to fall. When the UK actually finally go through and announce that they're going to cut interest rates, we might find that actually supply has already shifted quite a lot because of the anticipation, and so the actual final impact might be quite small, but we do generally see that before anything is fundamentally changed, the price starts to fall as the speculators anticipate what the value of the currency is going to be in the future. Okay, the next is money supply. So if a government or central bank decides to print money and increase the money supply, for example through quantitative easing, this might have an impact on the exchange rate. Often quantitative easing leads to an increase in inflation and a reduction in interest rates. And we've seen earlier that this is likely to cause a depreciation because of lower demand for the currency. Also, some of this extra currency may find its way onto the foreign exchange markets, so we might see an increase in supply. So if we were to look at our market again, if the UK government were to increase the money supply, we might see that this would possibly cause a reduction in demand to D1 and also possibly an increase in supply, so some of this extra currency. So the effect we would see is a depreciation. So increasing the money supply will often lead to depreciation of the currency. So that's our general relationship. The opposite would also be true. Now our final factor that might influence the exchange rate is the trade balance. So by trade balance we mean the balance between imports and exports. So if the UK runs a large current account deficit, this typically means they're exporting more than they are importing more than they are exporting. This decreases demand for the pound and increases supply, causing a depreciation. In the long run, this may correct though, because it causes depreciation, and as the pound weakens, it makes imports more expensive and exports cheaper, which might help balance the current account deficit in the long run. We also have to bear in mind that this may be offset by surpluses on the financial account. So actually there might be a lot of demand for pounds if there's a lot of FDI taking place into the UK. So again, we can illustrate this in our market. If the UK were to run a large trade deficit with the USA, then what would we expect to happen? Well, the UK are going to be buying a lot from the USA, so we need to sell our pounds to exchange them for dollars. Also, the Americans are not buying many of our imports, so there's not going to be much demand for pounds. So the impact of running a trade deficit with America would be we'd expect the value of the pound against the dollar to fall. So a general relationship here, trade surpluses should see an appreciation, and again vice versa, a deficit will lead to depreciation. So in this video we've looked at a range of factors that influence the exchange rate, and just one last message before I go is that often many of these factors will be exerting an influence on the exchange rate at the same time, and so often we have to make a decision about what's the most significant factor at any given time, and that factor is likely to drive the change in the exchange rate. Okay, that's enough from me. Thanks very much for listening.